are starting to realize that they can compete, and now they're realizing that they should compete. Maybe not because they want to be a competitor in America, but more because they need a way to access these minerals generally. And I'm talking not just silver and gold, it could be anything. They need a way to access things, and they need a way to transact between themselves in case their route to dealing in a commodity via dollars gets shut off. So it's only normal that these markets should start to develop. It'll take some time for them to evolve to the size of the American markets, but I think it's coming. And we're seeing the Shanghai Gold and Silver Exchange, that is really exploding in terms of numbers of contracts being traded.
The expanding BRICS purchases from China, India, and Saudi Arabia. We suspect other Middle Eastern players are buying through sovereign wealth funds, but we can't determine who it is yet. Anyway, these three cohorts demand physical metal outright, not promises of metal.
You can tell a market is under real strain when the moves look orderly on the surface, but the mechanics underneath are starting to grind. That's the backdrop Vince Lanci keeps coming back to. The big squeeze everyone talks about hasn't arrived yet. What we're seeing is the system trying to paper over a physical shortage that can't actually be fixed with more contracts or clever hedging. Here's the thing: London's silver pool was once the safety valve. Bullion banks could juggle futures on COMEX, shift metal around in London, collect the spread, and keep the illusion of balance intact. But that setup depended on one crucial ingredient: unencumbered metal. That pool is now dry. What's left is either tied up in ETFs or already committed to buyers who aren't part of the old Western playbook. Meanwhile, demand is pushing from every direction. U.S. industrial users have dropped the just-in-time fantasy. They're dealing with tariffs, supply risk, and thin inventories, so they're buying ahead instead of waiting. Investors are waking up too. Gold has already broken out, and silver still looks cheap in comparison, so the ETF inflows have started rolling in again. And then there's the quiet but relentless bid from emerging markets: China, India, Saudi Arabia, plus other Middle Eastern sovereign money, pulling physical metal straight out of the pipeline. All this pressure shows up in the structure of the market. Backwardation has kicked in. Prices keep pressing higher. And yet lease rates haven't blown out. Lanci's point is simple: that's not a sign of relief. It's a sign that nobody wants to lease metal because no one trusts they'll get it back. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Silver's short squeeze hasn't begun yet. Physical short squeeze. What we're watching is banks attempting to paper over a physical shortage as London inventories drain, industrial demand surges, and global buyers pull supply forward. This breakdown explains how the pressure is building. This, I guess, intro to a breakdown. The current stress in the silver market is not yet a true short squeeze. What we are seeing instead is the further financialization of a physical shortage. For decades, bullion banks monetized silver by holding physical metal in London while selling futures on the COMEX, earning the carry. That trade relied on London's inventory acting as a flexible supply pool for delivery. That pool has now been nearly exhausted, with most silver contractually committed to ETFs or flowing directly to new global players. Physical demand has risen from three directions, or three cohorts. U.S. industrial users who pulled forward supply to avoid tariffs during Liberation Day because of the critical mineral status. But in general, the just-in-time concept of inventory management is dying. The General Electrics of the world are buying the silver they need for their electronics ahead of time. The military, we would also suppose, is. Second, growing investor accumulation through ETFs as people become, as American people, American people mostly, become more acclimated, or reacclimated, I should say, to the price of gold as a proxy to inflation, while silver looks cheap compared to it, and that's happening. And the expanding BRICS purchases from China, India, and Saudi Arabia. We suspect other Middle Eastern players are buying through sovereign wealth funds, but we can't determine who it is yet. Anyway, these three cohorts demand physical metal outright, not promises of metal. At the same time, China has intercepted upstream supply by pre-purchasing concentrates and doré bars before silver even reaches the exchanges. Bullion banks have been either unaware of this or negligent in handicapping the risk of their supply chains being co-opted by China. Unable to source replacement metal, banks roll short positions forward to defer delivery, expanding balance sheet exposure while hoping future supply materializes. The physical squeeze remains ahead. The current phase reflects paper deferral, not resolution. Now, when we talk about this later, you'll see why. For example, lease rates have not spiked this time. Contango has disappeared. Backwardation is here, and price is going up. Lease rates have not spiked because no one is leasing metal or no one's making metal available to lease. And that says the market is forced, the shorts are forced to roll and defer when they can. But as I said, the current phase reflects paper deferral, not resolution. Silver sits at record highs amid constrained supply, global demand surges, and backwardation without capitulation, suggesting either prolonged financial stress or an explosion, or an explosive, I should say, physical repricing ahead. The bullion banks keep doubling down on black, waiting for a physical bailout, the martingale game. But they will likely soon get a Fed bailout in the form of lower rates, which in the long run will only perpetuate the problem. This is not a one-and-done event.
The West is losing its monopoly on how gold and silver are traded, and the shift is becoming too big to dismiss. Clive Thompson's point is that alternative markets aren't a future idea anymore. Shanghai, in particular, is building real depth. It's not big enough to challenge COMEX today, but the growth curve is steep. And once a market reaches a certain size, it starts shaping prices instead of simply following them. That's where things are heading. Now, about the so-called backwardation panic. Thompson tries to calm the noise. If spot looks higher than front-month futures, the first thing he checks is timing. Futures stop trading earlier, spot keeps moving. Compare the two at different moments and you'll think something dramatic is happening even when it's just a stale print. The genuine backwardation is there, but the fake signals make it look messier than it is. What this really means is that pressure keeps building on the short side. Every uptick digs the hole deeper. Some banks try to hedge by holding metal in London while staying short on COMEX, but that's not a clean workaround. It forces them to shift metal across markets, line up delivery windows, and pray that nothing breaks in the chain connecting London to New York. Let's get back to the interview.
I have an app which displays prices of silver on my computer screen, and it was jumping around all over the place. 1 minute it was displaying a price of $53. Next time it was $55. Then it's back to $50. It was kind of all over the place. So I don't know what was happening, whether they were switching the machine on and off or what, but something was definitely going wrong. Well, I think it's inevitable that systems which are similar to what we've been used to dealing with only in the United States are going to evolve outside of the Western countries. The countries are starting to realize that they can compete, and now they're realizing that they should compete. Maybe not because they want to be a competitor to America, but more because they need a way to access these minerals generally. And I'm talking not just silver and gold, it could be anything. They need a way to access things, and they need a way to transact between themselves in case their route to dealing in a commodity via dollars gets shut off. So it's only normal that these markets should start to develop. It'll take some time for them to evolve to the size of the American markets, but I think it's coming, and we're seeing the Shanghai Gold and Silver Exchange. That is really exploding in terms of numbers of contracts being traded. It's gone from almost nothing a year ago to I haven't got the figure. Obviously, it's still very small compared with COMEX, but it's been a huge thousands of % increase in a year. Yeah, I have to say I was surprised, but when you get surprised, it's usually an extremely bullish move, and you can see the strength of that move up. It's a very strong,
Yeah.
long green bar. And as I said, I think this was in some way reflecting the fact that suddenly people couldn't trade the futures. Therefore, there was nobody out there to suppress the price on the futures exchange, pulling down the spot price, and silver found its true price. It might be something similar to what I was seeing on my screen, where I was getting one price, then a completely different price. And I think maybe they were possibly feeding off the COMEX price, and then they restart the system, so they're giving us yesterday's price, then today's price, then yesterday's price. It's kind of backwards and forwards. So it might have been a bit of that. But I could see the price on my screen. 1 minute I'm looking at it, it's showing $51, then it's showing $54, then it's showing 51 again. And I'm thinking, well, is silver jumping around? It obviously wasn't jumping around.
No.
I've seen it happening that we are in genuine backwardation, particularly on the near months. That basically means the futures price, which should be higher than spot, is actually trading below the spot price. That seemed to have reversed itself recently. I haven't checked in the last few days.
Yeah.
But the other thing I'd actually caution people when they do look at this, make sure you're looking at the same timestamp for the futures and the spot market, because sometimes the futures are closed and people, because they close earlier than spot, and then people are comparing the closing price of the future with the spot price an hour later or 2 hours later, which can give a false impression sometimes. I think, given the momentum we saw on Friday, I think it probably opens a lot higher. I don't want to put a number on it because I'm going to be wrong, whatever the number is. But let's just say I think it will gap. Certainly, the shorts must be hurting at the moment on gold and silver, because every dollar it goes higher is costing the money. Of course, many of the shorts are technically covered because they'll have gold in London, for example, but they'll be shorted on COMEX. And that's why we had a bit of a problem earlier in the year, because of the problem of shipping the gold to meet the deliveries in New York. But of course, it's never a great thing when you have your physical metal one place and you've got to deliver it in another place, because you've got to be certain that you're able to ship it when you have to. Obviously, we don't expect any disruption between London and New York deliveries, but you never know.
What stands out now is how the old architecture is creaking while a newer one keeps gaining ground. The traditional hubs that once dictated pricing and liquidity are being forced to share that role with rising venues that move real metal instead of juggling promises. Add in manufacturers stocking up, sovereign buyers draining supply, and investors shifting from passivity to accumulation, and the imbalance becomes hard to disguise. Each layer of demand tightens the screws on a system that doesn't have the metal to back its paper footprint. Whether the stress shows up as pricing anomalies, delivery strains, or sudden shifts in where trades settle, the direction is the same. Control is migrating toward markets that value physical settlement over tradition. The question is how long the legacy structure can pretend otherwise. As these new centers expand their influence while long-standing mechanisms lose traction, do you think we're edging toward a moment when physical markets, not derivatives, start calling the tune for global pricing? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.